This month's special topic focuses on home price affordability and how it is measured. The silver lining in these record drops in house prices is that housing has become more affordable for prospective buyers. By the middle of 2006, national housing affordability had fallen to its lowest level since the beginning of 1986, and in 1986, mortgage rates were nearly 11%, not the 5% we saw in 2006. The increase was caused by the multi-year surge in house prices, plus the steady increases in interest rates resulting from the Federal Reserve's effort to tighten monetary policy. Since that time, affordability has improved substantially, and by the first quarter of 2008, it reached levels consistent with the late 2002, early 2004 period, when mortgage rates were at their lowest levels since the 1950s. So, how do we measure housing affordability and home prices? Housing affordability is comprised of mortgage rates, house prices, and family income. Of the three, house prices have made the largest relative moves in recent years and have had the biggest impact by far on affordability. There are three popular measures of house prices. First is the National Association of Realtors NAR Index. The second is the Office of Federal Housing Enterprise Oversight. And the third is the Case-Shiller Price Index. The National Association of Realtors Index computes affordability monthly. It estimates the median price of existing homes sold each month and uses that number as the house price measure in the index. So, while the NAR index accurately reflects the median price of homes that were actually sold, it's essentially a transactions-based approach, which means that it does not tell us what has actually happened with house prices. The NAR index shows that the median existing home prices fell by 8.9% in the 12 months ending in February. The Affordability Price Index and the S&P Case-Shiller Price Index are repeat transaction indices. Both have shown declines in national house prices recently, but the magnitude of the price decline has been very different in the two models. For the 12 months ending in February, Affordability estimated that prices fell by 2.4%. Over the same time period, the Case-Shiller Index declined 12.7%. Why do house prices differ so greatly between the Affordability Price Index and the Case-Shiller Price Index? Where the indexes differ is in scope. The Affordability Index covers every area of the country, but is limited to conforming conventional mortgage transactions purchased or securitized by Fannie Mae or Freddie Mac. What this means is that the scope of the Affordability Index is limited to mortgages on properties that were not financed by FHA or VA, and those with mortgages that did not exceed the conforming loan limit of $417,000. And Affordability doesn't count transactions on condominiums, cooperatives, multi-unit properties, and planned. The Case-Shiller Index includes homes financed by both non-conforming and non-conventional mortgage loans, which means it includes homes financed with jumbo mortgages, FHA, and VA loans, and other types of non-conforming loans, including a larger share of subprime and Alt-A loans. The second area of major differentiation is in the geographic coverage of the two measures. While the monthly Affordability Index is a truly national index with coverage from all 50 states, the monthly Case-Shiller Index only estimates for 20 of the nation's largest metropolitan areas. These differences account for some of the variation in the two models. But some of the differences are also the result of economic differences occurring between some of the nation's larger coastal areas and the areas in the interior of the country. In many of the nation's interior states, prices have held up much better than many of the larger metropolitan areas located in coastal states like California and Florida, and a little bit to the interior like Arizona and Nevada. The economies in many of these coastal states in the Southwest are slowing down more quickly than the national economy. And those are also the states that experience the biggest increases in house prices and the biggest declines in affordability over the last several years. So, how does this translate into a silver lining? Housing affordability is rising sharply in most parts of the nation. We at PMI anticipate that affordability will continue to improve until the excess supply of housing is reduced significantly. This has been our special topic for May 2008 in our Housing and Mortgage Market Review. Look forward to talking with you next month. Goodbye.